Let's discuss the cash versus accrual accounting methods. So what is the cash basis of accounting and when do we actually get a chance to use it? Well, there's some restrictions here. It's only used for government agencies or when your annual company revenue is less than $5 million. The concept is we take our cash receipts minus our cash disbursements and we're left with a term called net operating cash flow. Abbreviation is net OCF. It's a very simple process where you just basically measure your cash receipts or cash in and your cash disbursements or cash out. Now let's take a look at the accrual basis of accounting and its applications. This is a much more complicated process where you measure your earned revenue, we'll talk about that term later in the course, and its related expenses, regardless of when your cash is paid or received. This is basically revenue minus expenses equals your net income, or hopefully you don't have a situation where your expenses exceed your revenue, which would put you into a net loss situation. Keep in mind, this accrual method is required by generally accepted accounting principles, or GAAP. Let's take a look at the contrast between cash versus accrual accounting by reviewing an example where the credit sales are $100,000 a year. Here you can see what a cash accounting would look like. The cash receipts of $300,000 show us the actual cash collected from the customers for each year. The cash disbursements show the actual cash payments, or cash out, which include prepaid rent of $60,000 paid in the first year. This is very typical for items such as prepaid rent and prepaid insurance. In this case, our net operating cash flow in year one is actually a negative $65,000, in year two a positive $60,000, and in year three a positive $65,000. If you add those three up, the total net operating cash flow for the 3 years is $60,000. Keep that in mind. And this is what accrual accounting would look like for the very same scenario. Now we have the same revenue of $300,000, but instead we're now representing what the actual revenue earned from customers. We'll discuss this very important concept of earned revenue when we get into revenue recognition issues later in the course. Next, we reflect our related expenses, our matching expenses, which is something we call the matching principle, and we'll talk about more. It reflects the allocation of the rent expense over the 3 years, the period of time that the prepaid rent covers. Lastly, that gets us to net income, which is quite honestly an even $20,000 for each of our 3 years. And it still gets us to the total income of $60,000. So what did you notice now? The 3-year totals are actually the same, right? They're both $60,000. But the timing of the recognition of that $60,000 is what differs, which is quite honestly the major difference between cash accounting and accrual accounting.